All right, let's just jump right in. In the high-stakes, often brutal world of financial trading, what if I told you the real secret to winning has nothing to do with being right? What if it's all about becoming the absolute best at being wrong? It's a total paradox, and it flips everything you probably think you know right on its head.
And this is the core idea from a high-stake trader named Tom Hougaard. He says, "I am an outstanding loser. The best loser wins." Now, he's not talking about some genius ability to predict the future. He's talking about mastering the art of taking a loss. It's a philosophy that he developed from watching thousands of people for over a decade basically just beat themselves.
So, the big question is, how do so many smart, aspiring traders get it so incredibly wrong? Well, it turns out they almost all follow the exact same path, and that path leads them straight into what we can call the 99% trap.
And look, this isn't just a guess. In Europe, brokers are required by law to tell you this number. And on average, around 80% of retail trading clients lose their money. I mean, just think about that. For any other industry, that kind of failure rate would be absolutely insane.
And you can see this isn't just one bad broker. The numbers are consistently incredibly high across the entire industry. You've got failure rates hovering between 74 and nearly 90%. So it's not a fluke, it's a feature of the system. The real question is, why? What is going on here?
Well, the first thing people do is they try to learn more, right? They turn to these gurus selling super expensive weekend courses. But what they end up getting is usually just, recycled information on chart patterns and indicators that frankly you could find online for free. This stuff doesn't create profitable traders. It just creates people who are really good at drawing lines on a chart.
The actual problem runs way deeper. It's psychological. Most of us apply what Hougaard calls supermarket thinking to the markets. Now, in a supermarket, if something's 50% off, that's a bargain. You buy it. But in the stock market, a stock that's down 50% is not a bargain. It's a huge red flag of extreme weakness. You're not getting a deal. You're trying to catch a falling knife.
And this story just nails the point perfectly. Back in 2001, clients were piling into this stock called Marconi as it was just cratering. They thought, wow, what a deal. Hougaard's blunt advice was that they were bargain hunting in completely the wrong store. And you know what? That stock eventually went to zero.
So, okay, if the textbooks and the chart patterns aren't the answer, then what is? Well, it turns out the real fight isn't with the market at all. It's with our own hardwired human instincts.
Just take a look at Tom Hougaard's own story. I mean, this guy had degrees in economics and finance. He had the passion. On paper, he was perfectly qualified to do this, and yet for years, he failed. He realized his fancy education meant almost nothing. He only became successful when he stopped trying to understand the market and started trying to understand himself.
Now, at the very heart of this internal battle is this nasty psychological trap called cognitive dissonance. It's that awful, uncomfortable feeling you get in your gut when reality doesn't match up with what you believe. Like when you're sure you've made a brilliant trade, but the price immediately starts moving against you.
So how does our brain try to fix that painful feeling? Oh, in the most destructive way possible. When a trade is losing, our brain clings to hope. It starts searching for any little reason to justify holding on. But when a trade is winning, it gets flooded with fear of that profit vanishing. So it closes the trade way too early just to make the anxiety stop.
This right here, this is the gap between being good and being truly elite. The golfer Luke Donald once said that what separated him from Tiger Woods wasn't just raw skill. It was that after a bad shot, Tiger could instantly wipe it from his mind and focus on the next one. But Donald, he'd still be dwelling on the mistake, letting it poison his very next swing.
So it really forces you to ask yourself a tough question. And not just in trading, but in anything where performance matters. Is your mind on your team? Is it your greatest asset? Or is it secretly sabotaging everything you're trying to do?
All right, so this brings us to the actual solution. If the core problem is our own human nature, then the answer has to be in adopting a new, completely counterintuitive philosophy, learning how to lose, and how to do it well.
Just think about the difference in mindset here. When a trade is finally working, the losing trader's brain is screaming, okay, where do I get out? How do I lock this in before it disappears? But the winning trader, they see that the market has proven them right, and they ask a totally different question. Where's my next opportunity to add to this, to press my advantage?
And that huge difference in mindset leads to a completely opposite set of actions. The losing traders, they add to their losing positions hoping for a comeback, which just compounds their mistake.
The winners, well, they add to their winning positions. They compound their success. They do the thing that feels difficult and scary. The legendary pit trader Charlie D put it perfectly. He said, the true sign that you've made it as a trader isn't some huge, flashy win. It's the first time you manage to fight your own fear and have the discipline to add to a position that's already working. That is the moment you transform.
So, this all boils down to a pretty simple set of rules. Now, they're simple to understand, but they are incredibly difficult to actually follow. Rule 1. Always use a stop loss to define your risk. Rule 2. You have to assume every single trade you make is wrong until the market proves you right. Rule 3. Only when the market proves you're right do you even consider adding to your position. And finally, Rule 4. You never, ever, ever add to a losing position. Ever.
Ultimately, this completely reframes the entire game. You start to realize you're not trading charts or indicators or the latest news. You are trading your own mental and emotional weaknesses day in and day out.
And this isn't just some abstract theory. You can see it right here in the data. This report was taken on a day when major stock markets were hitting all-time highs. And what was the herd doing? Over 71% of them were shorting the Dow Jones. They were actively betting against the clearest trend you could possibly imagine. They were literally fighting reality.
This quick little story just captures the problem perfectly. Dr. David Paul, a brilliant engineer, was losing a fortune fighting a downtrend in a stock. All his complex software, all his expert analysis, it all told him the market should be going up. Then his wife, who knew nothing about trading, just looked at his screen and said the simple, obvious truth. All I see is that this market right now is going down, isn't it? And in that one moment, it hit him like a ton of bricks. His big realization was, I wasn't trading the market, I was trading my opinion. He wasn't trading what the market was doing, he was trading what he thought it should be doing. He was trading his own ego.
And that brings us full circle, right back to Hougaard's ultimate conclusion after a whole career of watching this happen. It is never the market that beats traders. They consistently and very reliably beat themselves. They snatch tiny profits out of fear, and they let huge losses run on hope.
And that really just leaves us with one final, crucial question to think about. The next time you make a big decision, whether it's in the market or just in life, you have to ask yourself, are you reacting to what's actually happening, to objective reality? Or are you just trading the biases, the fears, and the hopes that are swirling around inside your own head?